Continuing topic 4 of paper 3, conduct of business. Let's now look at paragraph 3.3, general principle 5 under the code of conduct, which covers information for clients. What is the information that intermediaries must provide or should provide clients? And we've listed there the first 3: information about its business, including contact details, services provided, etc. In the case of a financial services group, clear information about the particular company within that group that the client is dealing with, and if the client requests, the provision of audited financial statements. And the idea behind this principle is to provide an element of transparency of the business to the client. Also, at the bottom of page 4.16, we're told that the code requires a pre-sale disclosure to a client other than to a professional investor, so it's non-professional investor clients, to show whether the intermediary is acting as a principal or agent for the particular product, and any affiliation of the intermediary with the product issuer, any explicit monetary, non-monetary benefits from a product issuer, and the terms and conditions under which the client may receive discount of fees or charges from the intermediary. So that is transparency from the point of view of the intermediary's relationship with product providers and any benefits that the intermediary receives, so that the client is aware of that. We move on to general principle 8 under the code of conduct with regard to clients, and that is covering client assets. And it tells us that the licensed registered person should ensure client assets are properly accounted for, and that client assets are adequately safeguarded. Now, this is an old principle. It's been around for many, many years, and it's been usurped to a certain extent by the client securities rules and the client money rules, which are very exact and targeted rules with regard to client assets. Nevertheless, general principle 8, which is much more wide-ranging, still exists, covering client assets. Then we come to the part of the code of conduct with regard to senior management's responsibility. And here we start with general principle 9, responsibility of senior management when running an intermediary. And we're told that the senior management bears primary responsibility for ensuring the maintenance of appropriate standards of conduct, etc. Senior management are expected to properly manage the risks with regard to the business, so that they understand the nature of the business, internal control systems, procedures, risk management policies, and the extent of their authority and responsibilities. Senior management should understand the risks of its business. And many, many years ago, when we had new products in the market, for example, futures, it was quite evident senior management did not understand those products, with some major scandals emerging. I'm thinking of Baring Brothers Bank, but not so now, given that senior management are expected to know what their business does. Senior management should have access to all information about the business on a timely basis. Who is senior management in this regard? It's all directors, including shadow directors. And shadow directors are those directors that are not technically directors, but they give instructions to the board or to certain directors on a board. And so Hong Kong legislation recognise them as shadow directors, so they are included under this principle of responsibility. Responsible officers, and any individual who's considered to be a manager in charge. Now, there are 8 categories of manager in charge, and they're listed at the bottom of page 4.17. The first 2, overall management oversight and key business line, cover senior management while not involved in regulated activities. Nevertheless, they must be responsible officers, and so must be licensed. Now, the classic are CEOs, chief operating officers, head of marketing. Those types of individuals now are caught under the manager in charge to be both licensed and responsible officer. The other 6, from operational control and review down to anti-money laundering and counter-terrorist financing, don't have to be licensed, but the SFC wants to know who they are. And we can see at the top of page 4.18 a number of points that relate to manager in charge. Now, I would say it's peripheral material, but it is in there. So I'd be aware, and certainly from a practical point of view, if you have overall management oversight of an intermediary and you're not licensed, well, you're going to have to become licensed. That's the way it operates. Senior management's responsibility also covers, within the code, conduct requirements of electronic trading. Now, we've got the material here on those conduct requirements. I'm not going to go into them in detail because rarely do they come up in an exam, but they do cover the responsibility for orders, for the electronic orders, which cover management and supervision, adequacy of the system involved, record keeping with regard to design and development of electronic trading system, comprehensive documentation, etc. 4.22 also covers specific requirements on internet trading and direct management access. And here we're covering risk management, minimum client requirements for direct market access services, algorithmic trading system and trading algorithms. That's under paragraph 423 on page 4.20, which covers qualification, testing, risk management. Now we're down among the weeds with this material. Read through it, but I wouldn't necessarily be looking to know this 100%, because as I say, 7 to 8 questions in topic 4, it's an outside chance you're going to get a question on that material. Far more likely are questions on section 5, management, supervision and internal control guidelines. So these are guidelines coming out of the SFC for those that are licensed or registered with the SFC. The internal control guidelines focus on the internal running of a business, whereas the code of conduct that we've just considered deals with how intermediaries should behave to the outside world, how they should deal with clients. This is inward looking, and there are 8 key areas of the internal control guidelines. And I'm not going to go into these in detail. This is fairly general material. You should be familiar with it. Read through it and then do the relevant practice questions. We've got management and supervision. We've got segregation of duties and functions. And in each case, as you'll see, we give the objective and the control guidelines. Personnel and training, how that should operate with an intermediary. Then we have under 5.1.4, information management, which leads on to compliance. Once again, we're reminded that the intermediary should comply with all these rules, regulation codes, guidelines, etc. 5.1.6 looks at audit. Now, this is internal audit, not external audit. The objective and control guidelines, again, of operating an internal audit function. Operational controls, the objective and the control guidelines with operational controls. Now, do we need to remember all these detailed operational controls on page 4.25? No, these are examples. What you must remember is that there should be control guidelines to ensure compliance with all the rules, regulations, codes and guidelines that we are studying. And then the 8th key area of internal control is risk management on page 4.26. Again, the objective and the control guidelines. As I say, I'm not going into these in detail because you should really be familiar with regard to the operations of an intermediary. Again, nevertheless, have a read through and make sure you're familiar with that material. We then have additional information about operational controls and risk management. And again, this is reasonably straightforward, just a lot of material. And the operational controls that they give further information on, it covers account opening. That's the opening account for a client. Operating discretionary accounts, so they give you control techniques and procedures for operating a discretionary account. Providing investment advice, again, what you should be considering when providing investment advice to clients. Dealing practice, that's order handling. And that goes into a certain amount of detail, as you can see there, bottom of page 4.27. You should be practicing the recording and time stamping of orders, checking on the availability of money and stock. So you can see it gets into a lot of detail. Chinese walls, the operation of Chinese walls, segregating functions so that sensitive information, price-sensitive information is not leaked to operational staff, back office accounting, and finally, asset protection. Now, what is involved in risk management? And this is under paragraph 522. And this is very standard material in business management. You first of all need to identify risk that exists within the intermediary. And the different types of risk, the main four that are covered in the SFC licensing exam papers: liquidity risk, that's the risk of not being able to meet commitments while maintaining assets, that's financial commitments. Credit risk, the risk of losing money because a counterparty defaults. Market risk, the risk of losing money because of adverse movements in market values. And the fourth one, operational risk, the risk of losing money from deficient or failed internal processes, systems, or people. So management, senior management, should identify all the risks. Remember, this is under senior management duties, etc., responsibilities. Once you've identified risk, you should then measure the risk to see the extent of that risk. Once you've measured it, you should monitor the risk. And in doing so, you wish to control the risk through a number of techniques. Now, how do we control risk? Well, here's 4 sets of risk management techniques that are involved in running an intermediary. Here are the techniques at the bottom of page 4.29 for managing credit risk. And then on page 4.30, we have the techniques for managing market risk, liquidity risk, and operational risk for controlling those risks. This is fairly standard material, and if they examine it, you often are asked something along the lines of which one of the following is a technique to manage operational risk, and they will give you 3 that are wrong, and those 3 will be taken from credit risk, market risk, or liquidity risk, and then there'll be 1 technique that is indeed operational risk. For example, the first one there, segregation of duties.